So last video I went over 4 points or maybe even pitfalls that you can get yourself into as you're learning how to trade, or that will actually derail someone from becoming a trader. And the first point that I mentioned was not having a big enough sample size or enough years in your back testing. And you want to make sure that you do this, because if you just go back and back test a trade plan the last 4, 5, 6, 7 months, that might just be a certain market condition. And there's a few market conditions. They are an uptrend, a downtrend, a sideways market. Then there's multiple things that can happen to the market that can make it change directions, right? Long trends, short trends. So the more of those market conditions that you get in your sample size, the more confidence level you should have in your result. Now, right now I'm looking back in 2016, so this is over 10 years of data. You do not have to test all of that. If you have ever taken a statistical math class, then you'll understand that if you get that large range and then you randomly do the dates, you can, I'd probably say you want to collect, or at least get 25% of your data size, maybe even 30%. But once you get that, and again, there are 260 trade days in a year, 52 weeks times 5 is 260 times 10 would be 2060 times 0.25, 650. So if you collected 650 days worth of data, you should have a very high confidence rate that this is going to continue to work moving forward. So just remember, the larger the sample size, like the date range, it puts in more market conditions that are going to happen in the future to give you a higher confidence rate that what you have is going to continue to work. And then, like I said, if you get the larger the sample size, you could probably even get 500 trades, but you get 650. Have confidence that this thing is going to continue to work moving forward. Hope this helps, and we'll see you next video.